I know, I'm just kidding. So what is happening with rates? Will they drop below 4%? If so, when? And I'm going to go over that because a lot of buyers are on the fence waiting for this to happen. They expect it to happen as if it's a normal thing. I'm going to go over this with you and explain what needs to happen, what the challenges are in this market for it to happen, and then what we can expect for the future. So let's jump right in and let's look first of all on what current rates are doing right now. So here's Fannie Mae 30-year universal mortgage-backed securities. This basically tells you what the cost of rates are going to be over the as far as the daily breakdown. Each one of these is called a candlestick. As this moves up and down, so does the price of rates. So if you see this last week, we've seen a little bit of a trickle in the wrong direction, so to speak. So if you look right here, we're going in a downward trend, and that's not a good sign. So now we are below this. If you look at this right here, we are below this 25-day moving average. We tried to go up earlier today. When I woke up this morning at 5 a.m., I looked at this at 5:30 when they posted, and we were up here. We were positive 17 basis points. So we were trying to make a run at it, but we retreated all the way back and started going even before or even below this. So right now, we're not in a good spot because we opened beneath this 25-day and we're still beneath it. We tried to make a run, but we're not. So we have a lot of room to go downward here, which is not a good thing. We went down there last week or 2 weeks ago, I should say. So we don't want that to happen. So right now I'm in a locking stance, carefully watching to see if we can end the day in this range up here. But it's been somewhat of a rough go this last week, and it's not my favorite, but that's what rates are doing, and it's on the heels of inflationary pressures, the whole deal in Iran. It's just bad. And then we had some really hot, good jobs numbers. So with AI and with all of that going, we've got somewhat decent economy, not great for everyone, but there is growth, and we've got inflation. So it's not a good recipe for mortgage rates. Let's just say that. And we'll go over that in just a second. So let's look at the 10-year to see what the 10-year is doing right now, because that gives us a good insight as well. As you can see, we're below here, below the 25-day moving average um, last week, and we went above it, and then we went below it, and we went above it, and now we're clearly above it, and we're going to the next level of resistance. So I believe mortgage rates will get a little bit worse this week. I honestly think they're going to, and I'll go over the calendar. I think they're going to go all the way up into this range towards the end of the week on the 10-year. And I'll tell you why as we go into this. But not a good look right now. And it is what it is. Inflation, high jobs numbers, those are recipe for disaster when it comes to interest rates. So let's have a look real fast at what interest rates are really at. Whoop, I jumped way ahead there. Where they're actually at today. And it's not a good number. 666 is not good. So I didn't want to put this up here because it's ugh, but it is what it is. 6.66 on a 30-year fixed. Last week we were in the 6.4s. So we are higher. And 15-year in the low sixes, jumbos in the higher sixes. You can get adjustable rate mortgages a little bit lower, not a ton. So we have to weigh the pros and cons of doing an adjustable rate mortgage. We do have a portfolio product that's in the 5.875 range on a 5-year arm, which is it's a good loan. So if you have somebody doing, we can go that route. As you can see, though, we're in a negative territory as far as the trend. FHA is in the low sixes as well. Keep in mind, this is for a really good credit score. Most FHA borrowers typically have lower credit scores. So this is based on 780 FICO scores. And this is from Mortgage News Daily. So you can always go on there and see. So what's happening this week and why do I think rates are going to go up this week? Well, let's have a look at the calendar because it's not bond friendly, I don't think. It all starts on Wednesday with the CPI. This is the inflation. So CPI, the Consumer Price Index, is going to look at food and energy. and it's going to look over the month over month and the year over year. So this is not going to be pretty. We will see inflation up into the fours now. That's not good. The Fed funds rate or the Fed's target rate for inflation is 2%. So we're double that right now. Not a good overall trend. Now, this war in Iran is the reason behind it all. We need this to end. We need it to end. And I don't know how that's going to happen or the timeline of that, but until that ends, we're going to continue to see oil prices high. And then on Thursday, we have the producer price index, another inflationary number, and then also, or inflation number, and then also the initial jobless claims and continued claims. I don't think these are going to be bond friendly. So I believe that if you have customers that are under contract right now, I think locking is a safe position right now. I don't think this week is going to be good for mortgage rates. I could be surprised. We could see, and the problem with trying to predict what's happening in the markets right now is it's not based on normal economic market data. It's based on the erratic nature of what's happening in Iran with oil prices. So it's hard to gauge what's going to happen. But can we gauge into the future, like way into the future, like when will rates hit 4% again? Can we gauge that? And the answer is kind of. And I'm going to go over with you why rates, first of all, why they hit 3% and 2%, and why the Feds don't have as much as control as you might think. So I'm going to go over that in just a second here. But will they ever go into the fours or below that again in the future? Let's have a look and see why the Feds just can't cut the rates to help the housing industry. Well, first off, the Fed's mandate is to manage employment and inflation overall. So they have two levers to pull. There's not much that they can work with. So they can raise the Fed funds rate to try to help the economy, stimulate the economy. But they're looking at inflation. And if inflation is high, there is no chance of cutting rates. Zero. So right now, you've got, unfortunately, Warsh, the new Fed chair, is between a rock and a hard place. Everyone's demanding lower rates because it's hard on the markets, it's hard on the economy, but inflation is keeping rates high. So the Feds can't just arbitrarily say, you know what, we're going to lower the Fed funds rate, because once you stimulate the economy, that's inflationary. The markets will heat up, spending will happen, and that's inflationary, which causes rates to rise. So if they did it too early, if they cut the Fed funds rate too early, we could see mortgage rates actually go up, because the markets are going to predict it's going to be inflationary and mortgage rates could go up. So he's between a rock and a hard place on this one. And mortgage rates are long-term, and the Fed funds rate is overnight money, 24-hour money. That's it. So when you were looking at mortgage rates, we're talking about investors that are buying rates now, and they want to see if it's going to be a good investment for the future, and if their money will stay, if they have a good rate of return over the long term. So yeah, it's not short term. A lot of people think the Fed funds rate cutting will have a direct impact on mortgage, has a direct impact on the economy, but not mortgage rates directly. And then mortgage-backed securities support. So buying of mortgage-backed securities, I'm going to go over this chart in just a second. Buying of the mortgage-backed securities is the number one biggest factor as to why mortgage rates were where they were. I'm going to go over that chart in a second. But the Feds, their credibility matters. They're not going to just arbitrarily do things because they have a microscope over them as to how they manage the economy on inflation and on employment. And it's a tough go. So I would never want to be a Fed chair, but they got a lot of pressure over them and the voting partners. So it's going to be interesting to see with this Iran thing, but I'm going to jump right into this chart. This is a chart that looks at four different things: the inflationary rate, the 10-year treasury, the prime rate, and 30-year fixed rates. Now, these aren't exact, but they're pretty darn close. I want you to look at the inflation rate and the 10-year treasury where they were in 2020. Now, inflation actually got below, it was like 0.8. It was below 1%. So this graph wasn't 100% accurate. But inflation was 0.8. And because of that, mortgage rates were about 2 or 3% higher, and they were in the threes. But inflation was very, very, very low. So that helps mortgage rates get down. But the biggest factor behind why mortgage rates were in the below in here, it was inflation. And right now, if we have inflation at 4, I mean, we're nowhere near where it needs to be to get anywhere close to rates this low. So in order to get rates to be below 4, first piece, we need inflation to be below 1. We need inflation to be below 1. That's the first factor to look at. And second factor is the Fed's buying of mortgage-backed securities. I don't think this will ever happen again, but check out this chart. This is the comparison of how much the Feds were buying in mortgage-backed securities compared to where rates were. When they were buying mortgage-backed securities at the tune of $60 billion a month, yes, I said that right, 60 billion in mortgage-backed securities a month, we had rates at their all-time lows. Okay, they were in the threes, and they dipped below that the next month and the next year. And because look at the mortgage-backed securities they were buying. Okay, now compare and contrast that to where we are today. They are not buying any. In fact, they're selling them off. If you buy them and rates drop, what happens when you sell them off? Rates spike. So you see this correlation. It's a massive correlation, almost identical as to the Fed's buying mortgage-backed securities compared to mortgage rates. And it was a cliff that we jumped it off of on the buying side. And look what mortgage rates did. Boom. So inflation had a reason for this, because when the government goes in debt, that's inflationary. It helps short term, but let me just tell you, the Fed and the voting partners of the Fed and the Fed chair, they see this, they understand the inflationary measures that happened because of these buying these mortgage-backed securities. They saw what happened in real estate. Prices went up 50%. They know what a big dip in rates would do to overall inflation, and they're not going to let that happen. So right now, we're sitting at below zero when it comes to buying of mortgage-backed securities. They're still in runoff phase, and our rates are quite high. So if you look back at inflation, we're high on inflation, and we're low on mortgage-backed securities. There is not an ingredient in here that puts us anywhere close to having rates near 4% in the near future. Not even close. So what do we need? We need the mortgage-backed securities to be purchased either by us or by other countries. And right now, they're just not buying as many. There's not much foreign investments right now in our mortgage-backed securities. They're all investing in their own stuff right now. It's just that's the way it is right now. So we need the Feds to pump up the purchase of mortgage-backed securities. That'll help. And we need inflation below 1. So if you are talking to your customers and they're saying they're waiting for rates to be at 4, say, okay, inflation needs to be below 1, and the Feds need to start buying mortgage-backed securities above the $20 billion a month range. If those two things happen, we will see rates dip down into that. Will they happen? There is nothing in the foreseeable future to show that. Now, if the Feds cut everything down and you get inflation back down to 2%, rates could be in the 5s, high 4s, maybe in the high 4s, most likely in the 5s. Usually it's 2 to 3% over inflation where mortgage rates are. So the odds of us in a normal market with 2% Fed funds rate, the odds of us getting into below 4 are astronomically low. So if you have any buyers that are looking to purchase and waiting because they want rates to be down in the 3%, because let's just face it, the payments on your mortgage are very, very, very attractive when rates are in the 2s. If they're stuck on that attractive nature of the rates, and not the reality of will rates go down there, they're in for a rude awakening this next 3 to 5 years. So I hate to be the bearer of bad news, but this is the reality, and this is what needs to take place for mortgage rates to be below 4%. We need the feds to be pumping out and buying mortgage-backed securities at a very high level, and we need inflation to be below 1%. If that happens, we will see rates below 4%. But the odds of that happening based on the lessons that have been learned over the last 6 years, the odds are very, very low. So feel free to send this. This is on my YouTube channel, mortgageyoutube.com. You can send this to your buyers that are on the fence. This is data. This is real information. This isn't a feeling. So this is good information to share with your buyers. And we can always ask for seller buy downs. That's really the only way to satisfy the buyer's need for a lower rate in this market. Sellers are willing to do it on some properties, not all, but it is something that would really help them, because I honestly feel, and I just stopped sharing, so sorry about that, but I honestly feel that if they are waiting for rates to be that low, they're going to be very, very disappointed. They're going to be very frustrated in the future when they see that their homes that they're buying are maybe 2 to 3% or 4% higher in value, and they missed the opportunity early because they were waiting. So, any questions out there? Any in the chat? Any questions in the chat room on what's happening or what you've heard? Maybe some rumors out there about rates. Any questions you may have regarding how this all works? I'm here to help. All right, I don't see anything in the chat. So, if you do have questions, you can always, I'm a phone call away, and we can always discuss that with your buyers as well. Well, that's today's Monday morning mortgage update. I hope I didn't burst anyone's bubble and make them a little depressed as we move into the week, but that's just the reality behind it. And I hope that we can be a good educator to our buyers to really help them understand what it takes in this market and what's available, and what it's going to look like for rates to come down. But until then, you guys have a wonderful week, and we will be in touch. Pat had a question. You can chat. I just allowed you to speak.
Oh, Sean, you got me?
I do. Yes. How are you?
Hey, good. Hey, question. So, like the war in Iran going on, if we're not thinking, hey, it's going to get to four, if the war in Iran ceases and peace talks happen, like where do you see things going then? 5.5? Is it like that's kind of the impact that the war in Iran has, or is that more, hey, low six to high six based on the war in Iran?
I think once the war in Iran is over, um, there's two things that can happen. There's a lot of the demand for fuel is slowed down because people are just stopping. They just don't like to travel as much when the rates are higher. So that causes a demand in fuel. So
Sure.
we could have two things happen. We could have that Strait of Hormuz open up. Gas prices will plummet. They may go down to lower than where they were before this whole came out. Maybe
Okay.
it'll take some time, but you will see rates drop back down because the trajectory of where they were going, we were in the high fives, low sixes before the war.
Mm-hmm.
But we only dipped into the fives maybe 3 or 4 days out of the last 6 months. It dipped down below into the fives and then spiked right back up. So I expect in a normal market, no inflation, like once that all clears out of the system, I
Mm-hmm.
expect rates to be in the high fives, low sixes.
Okay.
Yeah.
So, because yeah, I mean, like, you talk with people all the time, oh, I'm at 275 or I'm at three.
Yeah.
Hey, and okay, so it's projecting, like you just showed the graphs, hey, it's probably not going to get down to four. So a realistic is hey, we're probably going to be bouncing between the 6.5 to 5.5, 5.75. Like that's
Yeah.
probably a realistic like 2 to 3 year outcome. Would you agree?
Yes. And if you look at all of the major predictions from all of the major institutions like the Mortgage Bankers Association, the Realtors Association, you look at the
Hmm.
major institutions like Citi, Wells, Chase, you look at all of their projections, and they're all in the low sixes across the board for the next 2 to 4 years.
Yeah.
And I say
Yeah.
that as an
So,
average because there'll be times where they dip.
mhm.
And that's when you do the whole marry the home, date the rate, right?
Yeah.
You
So
can
so
time a
then the
refinance,
question,
but you can't time the purchase.
yeah, the question then, and just trying to think of strategies how to best, communicate, pitch, etc. to buyers. Hey, let's try to get a 3-2-1 buy down. And then in 3 years, if rates are, like let's say you get locked in at a 6.75 right now, okay, like in 3 years it could be 5.75. Is that 1%? What's that going to cost them to refi at that point? Does it
Sure.
make sense if we're only going to be balancing between 6.75 and let's call it 5.75 or 6.5 and
Yeah.
5.5? If we're only balancing between that 1 percentage point, does that make sense to refi in 3 years, right?
Yeah. And it actually, I'm going to pull up a slide real fast if I can find it on the fly. Hold on one second. Let me escape this real fast. I want to show you how rate sheet works real fast. If I can find it, I don't think I can find it fast enough, but
That's
um,
all right.
let's just say rates dip to 5.75,
Mm-hmm.
and that's with no points.
Yeah.
The cost of a refinance, there's discounted fees for title and escrow. The loan fees are like 1,500. If an appraisal needed, that's about 500. So you could be right around $3,000. Now that's rolled into the loan. Or the way rates work, if 5.75 is par, you can go to 5.625 and pay money to get even lower in points. Or
Mm-hmm.
you can actually go up. You can go to 5.875 or 5.99 and
Mm-hmm.
get a lender credit to pay for the fees.
Mm-hmm.
So in that circumstance, I would say if your goal is to get the lowest possible payment altogether right now, maybe buy the rate down to 5.25 and we refinance you and roll the fees in. Or if you think rates are going to come down more, let's do 5.99 and do it for free.
Mm-hmm.
And then if the opportunity to refi at 5.5 presents itself, you're not kicking yourself for spending all this money on a refinance.
Yeah. Yeah. Okay. Because I mean, like you made mention, like we've talked, getting the 3-2-1 buy downs. I think those make
Yeah.
sense. The sellers, I think, are open to it. And so I'm kind of thinking, okay, hey, let's try to get you in, and then over the next 3 years, if rates do drop significantly, okay, then let's look at the refi. But if not, if over the next 3 years they're going to be hovering, then again, are you happy where you are right now because you got a great
Yeah.
rate, but like you're going to be sitting in the same spot in 3 years and pissed that you didn't move on and enjoy the lifestyle you want. And in 3 years,
Correct.
you may still be within a point of where you're at right now. So,
Yeah. Yeah.
like,
So yeah, I think we talked about this, the 3-2-1 buy down. The sellers pay for it. It's a piggy bank attached to your mortgage. Every
yep,
month you pull out of that piggy bank to supplement your payment to make your payment lower.
yeah,
If you
yeah,
refinance within that piggy bank where there's money still in the piggy bank, whatever's in there, gets refunded back to you.
yeah,
So it's a win-win for the buyer. The sellers have to be willing to pay for it, but you can refinance it anytime during that process. And it is a good little safety net. And a lot of times we're using it for buyers that aren't quite making the income that they know they will be making.
hmm,
So it's a good transition into their higher income in the next year or two. But
totally.
yeah, it's a great way of getting in now because I have people, believe me, I have people that were when rates were up to 4%, they were at twos, and when rates got into the fours, they waited because they wanted
Uh-huh.
rates to come back to 2%. And I told them, and not with inflation like this, and like, no, it will.
Yeah.
And they missed out on huge opportunities. So
Yeah,
waiting
well,
can
and
be
that's the thing I continue to try and pitch. I mean, I even am like, okay, hey, it's a $550,000 house and rates are at 6.5. Well, let's get rates down to 4.5 and watch that 550. Now all of a sudden it's a $650,000 house, and you're going to have to escalate because there's going to be 17 buyers for it.
exactly. Yeah.
Like, and as much
But
as you try and say
yeah,
that, there's still optimism that people think it's going to drop to 4, but I mean, yeah. And that's where I feel pretty confident, even hearing you say it, like, feel pretty confident. Hey, you might get under the fives, but how much is that? And what's the risk? And all of a sudden, again, let's say it does drop to 5.5, even that much, every buyer is going to flood the market, and every home that is relatively clean, it's going to have multiple offers on it. And
yeah.
so.
And don't, I mean, keep in mind, I'm locking a lot of people into permanent rates in the fives right now with seller paid rate buy downs. So
Yeah. And that's the thing. You're not going to get a seller paid concessions if the rates do drop like everybody says they want them to drop. You're
yeah,
not going to get, hey, let me ask for 20K closing costs. You're just not going to get that. The sellers aren't
no,
going to
you're
do it.
exactly
Why
right.
would
You're
they?
exactly right. But you know what?
So,
The illusion or the sweet taste in their mouth when they crunch the numbers based on a 3.5 rate compared to what rates are now, it's blinding. It
yeah.
really is like it's such a massive savings that they just live on hope and not reality, and they get themselves into a tough position of renting, renting, renting forever. So you get it.
Or I
It's
have
hard.
I have a couple people they're sitting in a home that they know is too small for their growing family and their kids are getting bigger and they're like we need more space and I'm like I get it and I get you're at 275 or I get you're at 3 and hey, you're paying $1,200 a month. That's awesome, but you're also punishing yourself and sitting in something that you're not happy in. So at what cost, It's
Yeah. There's a there's a rumor that the idea of being able to take your rate from one home to another is being
oh,
thrown around.
wow.
Um, I doubt it'll happen. It's too much of an undertaking, but there are countries, other countries that do allow this. If you have a mortgage, you could transfer it to another property.
Yeah.
Um, but I actually bought takemyrate.com
Oh, yes.
just because if that ever happens, I want to be on that bandwagon. But yeah,
Yeah.
that would change the game, that's for sure.
I'm sure that would get things very complex on your end too, of like how much is your mortgage, your rate, the rate that you're taking, how much does it cover, and then what's the difference? And I'm sure it gets tricky.
Yeah, it does. But it's, I mean, it would be possible if they allowed it, you know?
Yeah. Well, I mean, it's like an assumable rate, right? I mean,
Correct. Yeah. Yeah.
and that's why I got a couple clients that oh hey, I only want to look at homes that got assumable. It's like, well, okay. Like that.
Those are magic if you can get them.
Exactly. Yeah. And if it's a
Yeah.
VA assumable, well, there's just the dynamics that we've talked about. So,
Yeah.
yeah. Cool. Hey, all right. Well, hey, good stuff. Is there anybody else on the call right now?
There's three others right now. Yes.
Okay. Well, we'll talk later then. I got an
You got
update
it.
on uh,
Perfect.
a client.
Yeah. We'll chat after this.
All right. Sounds good. We'll talk to you later. Appreciate it, Sean.
Yeah, Pat, have a good day.
Thanks.
See you guys. Have a great one.